What's happening, options traders? Good morning, everyone. Well, in a recent video entitled, "Should You Consider Deltas for Covered Calls?" I had some traders email and say, hey, those are some pretty cool calculations. I could use those. Can you put them in Thinkorswim? And the answer is yes. You can do what are called covered returns, but they actually break them out into two different fields. So let's take a look at what those calculations are again, and then I'll show you how to put them on in Thinkorswim. And then, for those who are interested, I'm going to show you that there is a little discrepancy in Thinkorswim, and that I've been on the phone countless times with them and nobody can seem to find what the discrepancy is. So I wanted to point that out just in case any of the traders go, let me try to figure this out by hand. You're not going to get the same numbers. But let's start by taking a look at the covered returns in Thinkorswim. Now in Thinkorswim, the first one that they have, it's a list in a drop-down menu that you can choose, is called a covered return. And in my video, it was called the static return. And all that means is that we are assuming that the stock price is the same price as the day that you wrote that call. Now that doesn't mean that the stock price has to stay exactly the same throughout. It just means that when you go to close it, it's the same price as the day that you entered into the covered call. And the calculation is very simple. You're going to look at the option's extrinsic value divided by the stock price. Because remember, we're assuming that that's all you're going to do. You're just going to bleed away this extrinsic value. There's no capital gain because we're assuming the stock price sits still. So you're going to get a percentage, and that's your return. If you wish to annualize it, pretty simple. Take 365, you could also do 360, and divide it by the number of calendar days until expiration for your option. So if you have 30 days until expiration, take 365 divided by 30 gives you 12.2. Whatever the percentage is that you calculate up here, you're just going to multiply it by 12.2, and that's going to give you the annualized figure. So for example, let's say that the stock is 100 and the $100 call is trading for 3. Well, the first thing we're going to do is, how much extrinsic value is there? 3 divided by the stock price gives us 0.03. So you could say it's just a straight up or a simple return of 3%. But if you wanted to annualize it, if there were 30 days, we just found that that would be a 12.2 annualization factor. Take 0.03 times 12.2 would be 36.6, or about 37%. So that's just saying that if you were able to write this call every 30 days throughout the year, you would end up with about 37%. Now in my video, I approached it a little bit differently, and both of them are perfectly acceptable, but I said that your cost would actually be 97. Because if you bought the stock for 100 and sold the call for 3, you really have $97 into it. So if you earn 3 divided by 97, that's just a touch bigger, 3.09%. We annualize it, comes up to 37.7. But you can see it's not going to make a big difference. 36.6 versus 37.7. But as long as you remain consistent in your calculations, you'll at least have some benchmarks for what this particular strike and expiration is doing for you. Now Thinkorswim has another field you can choose called the max covered return, and in my video that's what I called the return if exercised. So here we're just assuming that yes, you're going to capture all of the extrinsic value, but now you're going to capture some out of the money value, because we're going to assume that that stock price is going to move all the way up to your strike and even beyond. It doesn't matter because you're just going to get that strike price at expiration. So if you do that, the calculation's a little different. We're going to look at the extrinsic value plus how far is it out of the money. And then we're going to divide that by the stock price. So you can see it's almost the same formula. The one we just saw was extrinsic value divided by stock price. Now we're just taking the extrinsic value and just tacking on the amount that it's out of the money. And that's just very simple. It's going to again give you a straight up percentage, the simple return. If you want to annualize it, do it in exactly the same way. However, if you use these formulas in Thinkorswim, you're going to get different results. And you might think, well, maybe they're using slightly different formulas. I'll show you in their very own education system, it is exactly the same formulas that I'm describing here, and yet you still get different results. So again, it's certainly not a knock against Thinkorswim. Anybody knows that I absolutely love the platform. It's more of just a curiosity where the calculations are coming from. So don't get discouraged if you're trying to work it out by hand. They're not going to work out exactly. So let's jump over to the Thinkorswim platform, find out how to put these on the platform, and then I'll show you where these discrepancies are. So now into the Thinkorswim platform, I'm going to use Apple for the demonstration. And I think most of you know that up here on your trade tab, you have these different fields that I call the wildcards. You can click on them, and there's a whole bunch of things that you can choose from to replace them with. You can also change these layouts if you want even more. You always have to have the bid and the ask, but you can certainly change these. So over here, I'm going to actually make this one the extrinsic value for now. And in this first one, go to Option Theoreticals and Greeks, and right down here, Covered Return. Choose that, and there it is. This is your static return. This is assuming that you get this extrinsic value divided by this stock price for this many days, and then it annualizes it. And so that's really all that you're looking at. Now, if you understand your options theory, you should realize that the at-the-money option will be the largest because it has the greatest amount of extrinsic value. So notice we start up here at about 36%, we start getting bigger and bigger, we hit to about 61%, and then we start dropping again. That's not saying that the at-the-money is the best, it's just saying that it has the most extrinsic value. So let's just try this one at the top, this 121 strike. If you take the 350 extrinsic value divided by the stock price, of course that raises the question, do we want to use the bid, the ask, the mark, the last? I'm just going to use 126.90 for right now, the asking price. So we take 350 divided by 126.90 gives us a number. That's going to be about 0.027 or almost 3%. If we want to annualize it, we take 365 divided by 27, that's the number of calendar days until expiration, and that's going to give us about 13.5. We multiply those together, and we get 37.3. And if you look at Thinkorswim, they're showing 35.98, about 36. So they're off a little bit. And it turns out, mathematically, to get this same number, you would need a stock price of $131.50. And take a look up here, whether you use the bid, the ask, the last, the mark, nowhere close. So I don't know where that's coming from. Now sometimes I've talked to other traders about this and they say, well, maybe TOS is using a different formula than the one that you showed. Well, if we come over here to the education section, let's come up here to the top and just type covered return. And right down here, it tells you they are taking the call mark, that's the options price, minus the amount that it's in the money. That's just a fancier way of saying it's the extrinsic value, right? Isn't that the way we find the options time value? Take the options price, subtract out the in the money amount, divide it by the stock price. And then to annualize it, take 365 divided by the number of calendar days. So it's exactly the same formula, and yet we're coming up with different numbers. So I just like to point that out because sometimes, traders will sit there and say, I just want to make sure I understand it and let me try to figure this out by hand, and you never will. So again, I've been on the phone with them many times and nobody seems to know why they're off by a little bit. So if you want to do the return if exercised, how do you do that? Come up here to your columns, down to Option Theoreticals and Greeks, and then come down to Max Covered Return. So this is just saying what's the maximum you could receive if not only do you get the extrinsic value, but the stock price goes all the way up to that strike. So this is only going to apply for out of the money options, because you can see that if we go back to our 121 strike, they would be the same numbers. See, that's exactly what we saw before. And again, that's just because there's no out of the money amount to capture. But let's come down to the 130 strike right there. What's the return if exercised? We take the 465 extrinsic value, but then we have to say the stock price could also climb to 130. So again, we're not sure which stock price to use, but if the current stock price is $126.90, that would be about $3.10 out of the money. So not only could I capture $465 of extrinsic value, but also another $310 in capital gains. So that would be $7.75 divided by the current stock price and then annualizing it out. And if you do that, you're going to find that it comes up to be 82.5%, and yet TOS is coming up 79.66, or about 80. So again, a little bit off. And if you go back to the Education Center and we go to the max covered return, let's go to max covered return, then you'll see right there, it's exactly the same formula. It takes the call mark plus the out of the money amount, it's exactly what we did, divided by the stock price, and then we annualize it. And if you do that, in this case, in order to get this number right here, the 79.66, you need a stock price of 131.02. So for the covered return, we needed a stock price of 131.50. Here we need 131.02. So they're somewhat close, but still very far away from the actual stock price, which is basically just under 127, not anywhere near 131. So once again, I'd just like to point that out for traders who might be trying to figure out these calculations by hand. They will not line up, but I can assure you that the calculations that I showed you are correct. But still, that doesn't necessarily mean that they're not useful. If you're looking to do some covered calls and looking for some benchmarks, put these on your platform so you can even put them on at the same time. So now I've got my max and my static return, and I can go down and make comparisons. Now, of course, which ones you choose is a whole different question, because that's where the art and science of options trading comes in. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.